2018 Review and Preview Conference, AM Best focused on the need for insurers to be innovative in their business to protect and strengthen their business profile and their long-term financial strength. And because innovation causes as many concerns and questions as it does provide answers for many, and this year's conference was our 25th conference, we thought it'd be helpful to look back over the last 25 years, to review the innovations we've seen over that period, and to consider what we've learned and how it might be helpful to deal with the many expected changes for the next 25 years. Following that session, we received many requests from attendees to share this session with members of their own organization. So Andrea Keenan and Stefan Holzberger have recorded this session in studio. They begin their look back at an event that created significant changes in the management of property catastrophe risk.
This was one of the early events in my life that really, kind of shakes you to the core.
We lost our home. My parents lost their home. Our office took a direct hit. So think about being in the business of insurance a few hours after that storm passes with no roof, no windows, no doors. Everything inside of our office was blown away.
Hurricane Andrew hit Florida on August 24th, 1992, and before it finished, Andrew destroyed 63,000 homes and damaged more than 100,000 others throughout Florida, leaving roughly 175,000 people homeless.
I remember, going home after the storm and seeing that devastation, seeing, everything had been, all the homes that were destroyed and the amount of folks living in pretty tough consequences.
Every single person in my firm showed up the very next day. And we worked tirelessly, truthfully, 7 days a week for months and months and months and months and months. And by December of that year, we'd actually gotten all the claims paid.
The insured loss to the insurance industry was about $16.5 billion, about 15 of that in Florida, another $1.5 billion in Louisiana. So this was a very severe wake-up call to the industry, and fundamentally it changed how property cat risk is dealt with in the United States forever.
"25 years ago, the United States was on the road to recovery from Hurricane Andrew. Americans affected by the storms were busy rebuilding their lives, and the insurance community answered with thousands of claims adjusters, billions of dollars of indemnification, and dozens of lessons learned. Legacy of the storm included tougher building codes, more robust catastrophe modeling, insurance risk transfer to the capital markets, and an appreciation for the complexities of underwriting catastrophe exposures. AM Best noted 16 insurer insolvencies as a result of Hurricane Andrew. We entered into detailed discussions with companies on quantifying their catastrophe exposure. We also enhanced our stress testing for severe natural catastrophe events.
And this is where our timeline begins. The insurance industry has been a part of our lives for decades, and for some of us, the lives of our parents and of our children. This year, AM Best celebrated the 25th Review and Preview Conference in Naples, Florida. And so in this presentation, we are celebrating and contemplating the last 25 years of the insurance industry and looking ahead to the next 25. In 1993, in the aftermath of Andrew, the economy was growing steadily, and we were enjoying favorable returns on secure investments. The 10-year Treasury was yielding over 6%, as we show on our timeline, and the Dow was still below 4,000. The largest insurers are those that we're featuring here on our screens, and the newest insurers, identified as the class of 1992, RenRe, PartnerRe, and Tempest, they were following in the footsteps of XL and ACE a decade before, who were the first of the global reinsurers to choose Bermuda as their home domicile.
As the property and casualty sector focused on the lessons learned from Hurricane Andrew, California was struck by the Northridge earthquake. Like Andrew, this was an event that altered our perception of risk. Insurers, as well as AM Best, became more deeply engaged with the catastrophe modelers in an effort to better understand the risk and how it could instantaneously affect the balance sheet. But natural catastrophe risk was by no means the only massive challenge the industry was faced with at that time.
These sidewalls have no limitation as to style, size, or geographical location. For example, this is the Woodbury Gardens development in Long Island, where wide use of asbestos cement shingles is made. This contemporary home shows how modern asbestos materials can be adapted to any style or design. Notice how the asbestos cement sidewalls help add dignity and charm. Here in Glasgow Village, neither high humidity nor winter ice affect walls covered with asbestos cement siding. Now let's move to California. Asbestos cement sidewalls are ideal here, for they come in many colors that are rich in tone, colors that will stay beautiful for a lifetime. And so it is. From New York to Los Angeles, from Miami to Seattle, in every climate, in every community, this new sidewall has brought better homes.
I like the looks of it, and it's never given us any trouble at all.
No trouble at all. What a line, if only. We now know what latency has to do with mass tort litigation and insured losses. By 1995, the industry had reported roughly $49 billion in asbestos losses. AM Best estimates that the ultimate insured losses for asbestos will reach roughly $100 billion. At this time, AM Best created its first market share-based survival ratio, which a few years later was adopted by the NAIC and is still in use at AM Best at this time. Ironically, healthcare coverage was also a national theme in the 1990s. Healthcare reform was hotly debated under the Clinton administration, and AM Best estimated that if the Clinton proposal became law, HMOs would have represented roughly 80% of the health market by 1997. Today, HMOs represent, of course, much less, although Medicare Advantage and Medicaid managed care remain high-premium HMO products. Despite the setback at the national level, 28 states adopted their own version of healthcare reform, and AM Best opined that health insurance companies with strong managed care relationships would benefit the most from healthcare reform. The life and annuity sector was undergoing a transformation, with 11 major life companies demutualizing through mutual or publicly listed holding companies. Life and annuity companies were focused on cost containment in an effort to fend off the banks who had a desire to not only distribute but also underwrite annuities through wholly owned life subsidiaries. In the health sector, we saw a wave of M&A taking place, which led to improved economies of scale, but also a drain on capital resources. In the end, the acquisition of weaker HMOs by stronger organizations did improve the sector's financial health.
By 1997, there were already inflows of lessons learned with both sides of the balance sheet increasing in complexity. AM Best at this time expanded its analysis to reflect these market dynamics and created a methodology enhancement to the BCAR, which created a holistic view of capital strength, integrating asset, underwriting, and credit risk into one model. This also marked the beginning of a new partnership between capital markets and insurance. Catastrophe bonds provided options to transfer risk alongside traditional reinsurance. In 1997, the issuance was $785 million. Present day, $12.6 billion. While the new risk transfer mechanism was gaining traction, the broad economy was accelerating with the surge of internet-based super companies. Gas prices were down and stock prices were up. We were in the midst of the new economy as brick and mortar stalwarts of the Dow had to step aside and make room for Microsoft and Intel, who had recently introduced its new Pentium processor. The first smartphones arrived, and BlackBerry was about to change our work lives forever. Alan Greenspan at this time observed excesses with warnings of irrational exuberance. At the turn of the century, there were also some geopolitical milestones. Hong Kong was returned to China, the Panama Canal was returned to Panama. The euro went live and challenged the dollar's position as a global reserve currency. Meanwhile, Y2K technology issues became a concern that frightened us, proved to be overblown, but is arguably the first of what we now consider to be cyber risk.
For the life sector, term wars had begun. Many of you will remember the slogan, "Buy term, invest the difference." Also, Regulation XXX and AXXX had entered the scene, and companies began contemplating reserve financing solutions using captives or surplus notes. AM Best would monitor these activities, assessing the risk associated with these different kinds of financing solutions. And while on the topic, principles-based reserving is finally due in 2020, a welcome transition to actuarially justified reserves for term and UL products. But all of these issues became secondary as the world was about to change yet again.
We lost so many of our friends and partners in the attacks of 9/11. And so I think it's a very personal issue.
It was an unprecedented loss. It was a loss that was not thought possible before.
The nature and location of the tragedy dictate that the majority of the losses will ultimately fall with the largest commercial carriers, their reinsurers, and the London market.
It had a huge effect on the market and a huge effect personally.
But it changed the industry in a way that is permanent.
The insurance segments most affected are property, aviation, business interruption, workers' compensation, commercial liability, and life insurance.
Really changing the whole perspective of the industry to a new risk that we couldn't even begin to imagine.
While the estimates of the cost to these losses continue to grow and the financial markets have staggered, AM Best Company believes the U.S. and international insurance companies will be able to meet their commitments. However, this assertion is dependent upon the ultimate insured costs of these attacks.
It just has changed the industry so fundamentally, and it's changed the thinking of all its participants, and it's permanent and everlasting.
AM Best expects to see increased insurance prices in order for insurers to achieve adequate operating returns.
Perhaps the most common statement of 9/11 was, "I can't believe this. How could this happen?" But I think that's really what we need to remember, is that in the insurance industry we cover risk, including risk we never anticipated.
Insurance offers protection, saving, financial planning, investment, and sustainability. It's the foundation for recovery, even in the wake of unimaginable disasters. Beyond contracts and claims, negotiations and rates, the industry can proudly show that when it really matters, the insurer's role is to protect, preserve, support society's recovery, and contribute to building a better future. After 9/11, the class of 2001 was born. Acknowledging the role that these companies played in stabilizing the market, AM Best used its rating new company formations criteria in the context of sound plans and talented management teams with successful track records. Soon after, AM Best assigned initial ratings to these organizations.
The actuarial profession was under intense scrutiny in 2002 as the industry reported adverse reserve development of $23 billion. The The majority of that development came from workers' compensation as well as the asbestos and environmental lines of business. Over this period, the sector was feeling ongoing pain as a result of several years of cash flow underwriting, the soft pricing cycle of the 1990s, and notably, the mispricing of carve-out workers' compensation business underwritten by Unicover Managers, LLC. By this time, there was a new appreciation of terrorism risk by insurers, the government. TRIA was enacted first in 2002, international agencies, as well as AM Best. At AM Best, we brought terrorism risk into our rating criteria and our capital model through stress testing, recognizing the potential for terrorism losses to lead to insurer insolvency. In the financial markets, the credit crisis and other than temporary impairments was adding pressure onto the life sector. Fortunately, RBC, which had been adopted a few years earlier, was driving a greater capital buffer, and this helped many life companies weather the storm. That said, there were still several downgrades which resulted from exposure to high-yield bonds as well as the weak performance of variable annuities. Also, enterprise risk management was gaining traction at this time, propelled in large part by the Sarbanes-Oxley regulations. Insurers were required to certify the accuracy of their reserves, and all these events led to a better understanding of risk correlations. This coincided with the intro of predictive analytics, which we now know was destined to really take hold in our industry in the years to follow.
By 2004, the insurance industry was continuing to evolve and the economy was in a steady state of economic recovery from recession, after recovering from the 9/11 attacks and after recovering from the dot-com bubble. Late in the year, the insurance industry turned its attention to the 4 hurricanes that hit Florida: Charley, Francis, Ivan, and Jean. These events ushered in a Nat Cat stress test, which, to a degree, prepared us for what was to pass in 2005.
When the storm hit, we kind of looked at the Weather Channel and heard back from a number of people, and it didn't seem to be that catastrophic.
Here is where the giant barge came through the levee protection and the wall on top of it during the flooding after Katrina.
And then all of a sudden, all hell broke loose.
This was a waterfall into the lower 9th Ward and inundated these homes with 20 feet of flood water.
Katrina was a huge event. 9/11 and Katrina kind of stand out as kind of those changing type events for our industry.
Katrina was an eye-opener, especially on storm surge and flooding exposures. And to this day, there's still a lot of ongoing debate about the impact of surge and wind.
We had over 1 million claims total. We collected back 10 years of all the premiums we pay in that one Katrina loss event.
The industry is very resilient and can pay for the claims that it needs to pay for. But as an industry as a whole, it came through the event very strongly and well positioned to continue going forward.
Katrina was really a turning point, I think, in the industry in terms of how we think about cat risk.
We have seen an explosion of analytics and modeling come into the marketplace over the past 10 years.
Because of Katrina, there's a real focus on urban resilience and recognizing the potential fragility of our infrastructure.
How do we better prepare communities around the U.S. and around the globe to be more resilient in the face of floods and earthquakes and hurricanes?
Insurance companies take pride in helping clients in many ways, which produces customer loyalty and long-standing relationships. But some unproven relationships were taking hold as alternative capital was entering the scene to a greater extent, which represents flexible investors with deep pockets. After 2 years of extreme US Nat Cat activity, reinsurers started managing coastal aggregations cautiously, and state-run property risk pools filled with coastal policies. Industry veterans saw opportunity, however, and the class of 2005 arrived. The new company formation methodology, also at this point used for startup E&S companies, served the industry again post-Katrina, Rita, and Wilma.
After the brief recession back in 2001, economic growth in the years following was taking on unusual characteristics. Household incomes were not increasing significantly, yet housing prices were soaring, and corporate profits were stellar, while interest rates hovered at around 4.25%. The variable annuity marketplace was highly competitive, with generous product features such as roll-ups and guaranteed minimum withdrawal benefits being very common. It was a time of rich guarantees with ineffective hedging in place. These competitive conditions continued right up to the financial crisis of 2008.
And in 2008, Greenspan's irrational exuberance came home to roost. Banks had employed irresponsible lending and complex financial instruments. Risk models were accepted, but they were faulty in their predictive powers for extreme tail events. Also, improper credit ratings were assigned to complex structured products.
None done by AM Best.
Thank you, Stefan. ERM had been taking hold but was not yet able to capture the depth and complexity of the risks to the financial system at this time. Lehman Brothers and Bear Stearns collapsed, AIG teetered, and Fannie Mae and Freddie Mac were in receivership. In addition, a handful of small life companies with heightened investment risk became insolvent.
A major insurance company, one with a name that everyone knows, that's on the verge of going bankrupt. The leisure is gone. We have to do something. We tend to focus on the stock markets. That's not the issue. The stock markets are not the issue. It's the credit markets. The credit markets are frozen. Harry, you got to start regulating. You've got to regulate the financial industry. It's going bad. We need to regulate, and that is what we are going to do.
And regulate they did. The insurance industry was caught under the weight of layers of regulation, some old and enhanced, some new, some global. Dodd-Frank was signed into law, and the hunt for systemically important financial institutions began. In the United States, Pru, AIG, and Met were to look forward to the highest regulatory capital standards due to their perceived threat to the financial system and the global economy.
The financial crisis left us disenchanted with the value-at-risk models utilized by the banks. Yet, financial services sophistication continued to evolve in the insurance sector. One sign of the increasing fluidity of risk transfer was the competitiveness of capital markets in the property and casualty reinsurance sector. New risk transfer solutions emerged in the form of insurance-linked securities that were both innovative and valuable to the customer and benefited the investors, mostly pension funds and endowments at that time, as a great diversifier and a yield pickup in a low-rate environment. For property and casualty reinsurers, this led to pressure on high-margin, peak zone catastrophe business. At the same time, interest rates had been on a precipitous decline since all the way back in the 1990s. And this was trouble for the life and annuity sector in that it put added pressure on profit margins.
The Obama administration around this time launched the Affordable Care Act. By 2014, however, the market struggled to price the risk of exchange membership, and risk corridors showed significant shortfalls. Similar to the actions taken by the Clinton administration, the passing of the ACA resulted in a shifting of the players in the health market. WellPoint and Amerigroup merged and became Anthem. They were almost absorbed by Cigna, too, if it weren't for government intervention. Speaking of government intervention, soon after the Northeast was pummeled by Sandy, reminding us that the government is so powerful it can turn a hurricane into a superstorm.
Good one, Andrea.
Thank you. In 2015, AM Best embarked upon a new methodology update, which was to be released in 2017 as the Best Credit Rating Methodology, or BCRM. Built on a more flexible foundation, the methodology is able to adjust to current market dynamics. By this time, the focus on enterprise risk management has grown both in the industry and in the ratings process. The Chief Risk Officer, a term that was actually first seen in 1993 at the beginning of our timeline, is now an essential part of our industry. Boards of directors focus on ERM, and risk management consideration are voiced at the top table in strategic discussions at insurers, both large and small.
We enjoyed several years in the U.S. with no major natural catastrophe until 2017, when Hurricanes Harvey, Irma, and Maria produced devastating losses in Texas, Florida, and Puerto Rico. And these events were followed by 2 rounds of unprecedented wildfires in California. But times have changed. This time around, there will be no class of 2017, as the market has absorbed these losses and reloaded capital as necessary. Housing codes showed resilience in Florida and Puerto Rico, but less so in Texas, where we see some of the most lenient building codes despite the significant exposure. The National Flood Program continues to be on shaky ground, with issues around funding and political acceptance. In 2018, on a positive note, the NFIP purchased more reinsurance protection than ever before, with 28 professional insurers providing roughly $1.5 billion of coverage. The private sector truly has a prominent role to play, but of course, insurers must be able to charge an appropriate price. Which brings us to 2018. We started our timeline with Hurricane Andrew. The PC industry has really come a long way in handling natural catastrophes, with many lessons learned from Harvey, Irma, Maria, Northridge, Katrina, and so many other events. The life sector has evolved significantly as well. At the beginning of our timeline, the sector was recovering from the failures of Executive Life, Mutual Benefit Life, and Confederation. Life and annuity writers have survived financial crises and 10+ years of record low interest rates. The sector has responded to these crises by appropriately shifting strategies and product features. It's been no day at the beach for the health sector either. Health insurers have been subject to rising medical costs and increasing demand for coverage, as well as the ever-changing regulatory environment. But these organizations have adapted well through strategic partnerships, mergers, and acquisitions, all in an effort to maximize diversification, synergies, as well as economies of scale. We've seen advancements in technology and risk management over this period that have allowed the industry to withstand a confluence of catastrophic and financial market events. Many of you have witnessed these structural changes to the insurance market. In managing risk over the past 25 years, the industry has driven improved building codes and highway safety standards, developed predictive analytics and risk-based capital modeling, and introduced enterprise risk management, as well as new innovative risk transfer instruments. The industry today is so interesting, it's highly attractive to a new generation of innovators and disruptors who have introduced us to the shared economy techniques, fintech applications, cutting-edge risk transfer solutions, and endless possibilities. These latest innovations that are in high demand in our industry will help us figure out what we might anticipate over the next 25 years.
I think the next 25 years is going to be a bit different. It's up to us as an insurance sector to actually drive the big change.
So much of this world now is interconnected, and risks are going to connect
in very surprising ways and trying to manage and understand that knock-on effect.
The age of risk has just begun.
This world continues to get riskier in terms of climate change, in terms of geopolitical aspects.
Really important change is for the industry to take more of that risk.
The way we buy insurance, our expectations in what reinsurance does, what kind of products it delivers to individuals and businesses will be fundamentally different.
The ability to rapidly assimilate data.
And what our industry learns to do with that data will be very powerful.
I think it has to be globalization.
How global the market has become.
What we will see going forward is additional risk-taking by capital providers.
There is still a significant level of underinsurance in the world.
The industry is going to rely more and more on the technology and the information that's transforming so many industries right now.
Photonics, genomics, big data, robotics.
The train has left the station. Robotics are here to stay. Artificial intelligence are here to stay. And we're going to have to learn to live with the consequences.
If you asked me even 5 years ago, we may not have even thought that cyber insurance would have been a big deal. So going now 25 years into the future, I'm guessing it's something that you and I aren't even thinking of today.
Already, artificial intelligence, big data, Internet of Things, virtual reality, robotics, molecular modification, it's already on the scene. Our perception of what is possible has shifted. Health advances will shift from wearables and online patient-doctor interaction to instantaneous diagnostics and treatments. Robotics will perform specialty surgery with a doctor monitoring the procedure from thousands of miles away. Lifespans will continue to increase, and artificial components will create a generation of bionic people. Someone born today could live to be 150, maybe even 200. 70-year-olds of 2044 will not look 70, and we will look younger and have a higher quality of life, won't we, Stefan?
Most certainly.
Absolutely, if we can afford it.
Afford it indeed. Clearly, there's a role to play and opportunities for life insurers in this market to help customers with longevity solutions, for one, as retirement planning becomes more and more critical. You have the death of defined benefit pension plans that will leave a void, not to mention the ongoing pressure on Social Security benefits. For the younger generations, they need to be educated on the importance of savings and financial literacy. Challenge will be to induce them to invest in accumulation products early on. Time will tell if these efforts prove successful.
Millennials adapt to advances with ease, and they demand speed, convenience, and personalization. They challenge suppliers to imagine a new era of customer experience. The shift in the composition of the population and workforce as baby boomers retire towards that shown in our graphic on the side screen, it will create the dominance of millennials who grew up with all of this technology. We marvel that the Jetsons has become reality. The millennials, they laugh at its simplicity.
Present-day creativity and innovation is already recasting our definition of risk. Let's take, for example, transportation, where today people and goods are moved by train, by plane, by car, by ship, that are controlled by drivers, conductors, pilots, and captains. But what about in 25 years from now? Today, drones have no trouble carrying cameras around, as we well know. Tomorrow, equipment, consumer goods transported by drones? Very likely. How about people? Very possibly. Coming soon, we'll see driverless cars and driverless cargo transport becoming mainstream. But what's after that? Flying cars, vehicles that transport civilians into space? Jetsons, here we come.
But what of the innovations that already exist that are both enabling insurance and challenging it? 3D printer is a challenger. It presents to us multidimensional risks: property damage, cyber, intellectual property, liability, or blockchain. That's an enabler. It authenticates settlements, it reduces error and costs, it increases security and the speed of transactions. But it's also a challenger. Fraud, cyber, we have yet to see its limits. So we pause and we consider all the protection necessary because of technology and advancement, and use our experience from the past 25 years that has given us ERM, predictive modeling, and alternative capital, which in turn is enabled by technology. And we boldly move forward and provide the protection necessary because of technology.
As we harness big data to better understand risk, a whole new set of risks are on the horizon. What does this mean for insurance? Could we see a move away from personal auto, homeowners, commercial property, and GL toward a vast broadening of products liability and personal liability, with cyber threats at the forefront as technology becomes more and more vulnerable to hacking? These emerging risks will very likely evolve out of the excess and surplus line segment, but eventually they'll shift into the core portfolios of the admitted market. New categories of risk will arise as technological advancements interfere with airspace, privacy, and public safety. Cyber liabilities will evolve as both a threat and an opportunity, and should be treated less like a line of business and more like a peril, similar to natural catastrophes or terrorism events, with one event having the capability of hitting numerous lines of business simultaneously. Clearly, cyber is highly unpredictable, even more so than Mother Nature.
But while on the subject of weather, we also observe that a growing number of the population is preferring the coast. Retirees are moving to the shoreline, and communication advancements allow for remote work while being plugged into the major business centers. Miami-Dade is predicted to be a mega region by 2050. Interestingly, Miami-Dade is also cited in a recent climate study as being completely underwater in the event of a 2-degree temperature rise. And if you look closely at the map we show on our screen, you'll see that Naples, which is where we just held our 25th anniversary review and preview event, will also be underwater. So we can predict with relative certainty that the 50th review and preview will not be held at that resort.
I don't know, Andrea. I think there's a good chance the Ritz-Carlton will find a solution to that problem.
Maybe, Stefan.
At any rate, regardless of the public policy decisions, we can expect property lines to see increased loss severity. A growing population, higher home values, the increasing threat of mega catastrophes means that the industry must develop creative new risk management solutions. In the near term, the growing number of environmentally conscious millennials in the workforce will bring climate issues to the forefront. Technology advancements will focus on preventing a rise in sea surface temperatures. Insurers, state risk pools, and the federal government through the NFIP are all going to be expected to provide protection for those who live and work along the coasts or in flood-prone areas. But in what form? Millennials will drive innovation, but also usher in new economic challenges. They will be managing massive student loan debt that cannot be discharged through bankruptcy and is subject to a Social Security offset, while the older generation experiences a reduction in government benefits such as Social Security, Medicare, and Medicaid. A lower percentage of millennials will own homes, and many will work shorter hours as contract workers. For those in the gig economy, health premiums could become prohibitively expensive. Many of the healthier individuals are very likely to go without. Intuit predicts that by 2020, 40% of workers will be independent contractors, saving businesses in terms of benefits, office space, and training, but certainly ushering in plenty of new challenges. So the workforce changes could affect health insurer earnings as well. Group medical currently makes up roughly 70% of the sector's earnings. This could fall to 50% within 25 years. Life and annuity writers will likely find it challenging to attract young consumers to accumulation products for a more stable retirement. The industry will have to figure out how to provide benefits to workers that do not belong to any one company. This gap in product offerings will allow innovative insurers to find solutions that appeal to this new policyholder. The economy will benefit from technology-driven efficiencies and productivity, which are in and of themselves anti-inflationary. Yet bubbles will still emerge, as we saw with Bitcoin. We can expect changing consumption patterns and profit models from a growing population and the ongoing integration of Chinese consumers and products into the global economy. Volumes of global trade will increase, and unfortunately, so will the wealth gap. Public policy solutions will become limited. The funding gap for Medicare, for example, is already estimated to be $70 trillion. The student loan bubble is likely to burst at some point in the near future, and that means generations unfamiliar with inflation may well have to adjust their savings and spending habits, shifting bond and equity market dynamics along the way. Insurance-linked securities may lose their appeal to capital markets investors, which would be good news for the traditional players in the property and casualty reinsurance sector, but at AM Best, we feel this is highly unlikely to happen.
Let's talk about healthcare. Today, we go to the doctor having already investigated our symptoms on the internet, and pressure is mounting for better coordination of care. There are greater use of quality bonuses for carriers who provide better care. The health sector is getting real-time data with wearables, and the use of wearables will expand rapidly in the future. Coming soon, diagnostic tools that can easily diagnose basic ailments. And one day, tools will prescribe treatments for less complex illnesses. Eventually, the prevalent use of robotics for surgery will contribute to the dehumanization of the medical profession. Our prediction that traditional health and medical coverages will be supplemented with products liability, cyber-related covers, and other specialty lines of insurance. Ultimately, these new classes of insurance will move from the periphery to the core and be as common as writing a homeowner's policy.
And what about life insurance? Not only will we know the policyholder's medical history, but also their genetic proclivities. Diagnostics will allow for precise underwriting of protection policies, and customers will look for differentiated products. We'll see a shift from the traditional face-to-face distribution channels in the low and middle market, and a move away from higher premium cash value life products will pressure the traditional life insurance agent. Longevity products will become mainstream, and a budding reinsurance market will emerge as the risk pool becomes too large to be absorbed by a handful of players. Finally, the increasing role of asset managers in the manufacturing and delivery of retirement, savings, and income products will have the potential to disrupt the traditional life insurers. The latter must be agile and be prepared to compete in this market.
Don't discount the regulators in all of this. They will continue with their focus on privacy rights, consumer protection, access to insurance, antitrust. Technology will not run away and take control. The NAIC is already actively engaged with InsurTech. Antitrust will not allow for the financial services sector to consolidate into just a few firms. The government will always have someone in the risk transfer value chain to hold accountable for consumer protection. We predict that regulated entities, however, will become more specialized in underwriting and claims handling rather than capital providing.
Andrea, it's true that the regulator will always have a role to play. Yet they may not stop or even slow a move towards consolidation in the life sector. The catalyst would be that pure protection business becomes commoditized thanks to the ample supply of data. For longevity risk, ultimately no company may want to take on this risk, and all benefits could become fixed across the product spectrum of pension risk transfer, long-term care, and certain annuity products. In the end, it could be hedge funds and other alternative capital sources that could become the common capital providers of tomorrow. In the future, web exchanges could become the clearinghouses for underwriting. Blockchain will handle the claims and billing with very little human interaction, and most communications will occur via Skype. Insurers will have large technology departments. The most successful will have integrated technology directly into operating strategies and management philosophy. We'll see a partnership, or could the partnerships amongst the industry titans, such as Berkshire Hathaway, Amazon, and JP Morgan, could these partnerships become a sign of the future of corporate America, not to mention the vertical integration seen in healthcare with CVS and Aetna, or Amazon choosing to offer over-the-counter drugs online?
Or an alternate reality may surface. Underwriting will continue to become more precise and personalized. Companies intimately familiar with their policyholders will have a distinct advantage. The sharing economy reflects the ongoing power of community values. Smaller niche players will win the day, and those that have a purpose or social benefit will attract tomorrow's entrepreneurs. Fraternal societies will strengthen with the sharing economy. Uber and Airbnb, they could find comfort in like-minded individuals being insured by a local carrier. The mutual model may experience a resurgence as common causes and a meaningful purpose rise with the dominance of millennials. They relate to slogans like "a better way of life," "on your side," "live life well protected." Insurance today is a localized business. It may very well remain so in the future.
It's a very good point, Andrea. Predictive information is the backbone of risk selection and pricing. Big data and predictive analytics will drive precision when underwriting known risks. Applying these metrics and tools to emerging risks will really be the big challenge, where the data is not nearly as rich. For AM Best, our financial strength ratings contemplate the successful integration of modern underwriting tools into the business profile assessment. We think this will increasingly become a differentiator in terms of a company's ability to achieve a sustainable competitive advantage.
We believe that the crises of tomorrow will be more severe than those of the past, but our industry is better equipped to handle them. The California Earthquake Authority estimates that there is a 99.3% probability of a 6.7 or greater earthquake in California sometime in the next 30 years. That's the same level as Northridge. Atlantic coast dwellers on any given year face a 40% chance of a hurricane. New dynamic economic actors could contribute to a market crash, the likes of which we've never seen. But armed with the tools that we have acquired over the past 25 years, we are able to monitor, analyze, and stress test for these eventualities. Insurers and their clients have better awareness of risk, real-time information, stronger physical structures, and rapid communications to aid them in these crises.
As technology advances, so do the risks faced by society. Some will be completely new and unanticipated. Let's take, for example, how technology could change the nature of sports. Will we lose our tolerance for football-induced concussions and chronic pain and the insurance claims that follow? Will players of the future be exoskeleton-clad elite athletes who introduce a whole new audience experience and new risks to insure? Will ethics be challenged by robotic enhancements and genetic engineering? Or let's take a look at a very different example. Are we ready for the next casualty catastrophe as a generation of mobile device and PC users suffer from chronic hand and wrist pain? Could this be the next asbestos? And will the industry be prepared for such an event? Ride-sharing, facilitators, and self-driving cars will be covered under commercial lines policies. We know that technology reduces the need for manual labor and increases safety, which results in workers' compensation seeing less and less claims frequency over time. But this could very well open the door for more cyber-related losses from robotics and other forms of automation. Life cycle products will be more available to families. They are providing personalized solutions to suit their circumstances, their genetic makeup, and their risk tolerance. Could these advances make it harder for high-risk customers to find suitable life and health cover?
If one thing is certain in insurance, it's uncertainty. There will be another storm. And as Stefan mentioned before, we add to the potential of Nat Cat or Casualty Cat the possibility of Cyber Cat.
Cyber Cat's kind of scary.
It is so scary. What will that do? What will be its impact? Will it be debilitating? Too severe to recover? We predict the path of the industry will mirror that of society and technology. And there will be in the future, like in the past, an insurance industry to support, facilitate, enable, rebuild. But if we fall behind, we risk obsolescence.
Okay, we've already achieved the Jetson Society, so what's next? The farther out we look, of course, the more uncertain things get. How will society, governments, our culture react to the new frontiers of physical ability, travel, adventure, medical advancements? Which of the things we know are possible will become commonplace? Flying cars, underwater hotels, civilian space travel? Well, back down on Earth, we already see self-diagnosis increasing the demand for pharmaceuticals. Medical professionals have to balance the convenience of ready access to these drugs with protecting the patient, oftentimes from himself. Solutions will come in the form of public and private sector partnerships, certainly with a prominent role to play by the insurance sector. This session was meant to explore the past and open up our minds to the possibilities of the future. These possibilities are endless, but they don't have to be overwhelming. The younger generation of AM Best analysts would agree. So we thought it best if we left you with some of their thoughts.
The world's risk landscape is definitely changing, and you have this perfect environment for really savvy and innovative companies to step in and play in and get really creative with new solutions for the growing demand.
With the Internet of Things allowing us to have a better understanding of risk through the accumulation of data, I believe that in the future you'll see the insurance industry covering risks that they wouldn't typically think were possible today.
In the future, when you're using your Uber or your Lyft app, a driverless car is going to show up. Incorporated into that fare, you're going to see a usage-based insurance premium.
It's going to be things like system malfunctions, network errors, or even hacking that may cause the accidents of the future.
I think in the healthcare industry, we're going to see a restructuring of the relationship between patients, providers, and insurers.
We're able to collect more data and understand risks more thoroughly, and I think that this will allow the insurance industry to cover risks that they don't typically consider or haven't covered yet.
There's going to be hacking risk for almost everything that you own. Your car will have hacking risk, your home. Think about all the connected devices.
Cyber can reach the scale and magnitude of a natural catastrophe.
I think it'll be important for life insurance companies to make sure they know how to reach the millennial market. Part of it is also going to be the insurer's ability to educate some of the younger generations on the importance of life insurance.
I think the industry is definitely prepared for the future. Companies are well equipped to adapt to emerging risks.
There's going to be different ways of marketing the products, there's going to be different ways of pricing the products, different ways of underwriting.
There are huge growth opportunities for insurance on a global scale.
Everything is evolving, and this industry has to evolve with it.
Thank you for taking this journey with us.